And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the podcast and to our YouTube channel. And if you think somebody might find this of interest, why don't you go ahead and hit the share button and you can share it with them as well. So we've had a few good years in the markets, and from time to time, people come up to me and they go, "Oh yeah, I did really well. I bought this stock and it made amazing. It was amazing, and I don't really think I need to use an advisor. I'm pretty good about this myself. It's pretty easy to buy and sell highly profitable stocks." Every now and then I write an article or I do a podcast and somebody comments and goes, "Yeah, well, those are, those tried and true ideas of, rebalancing your accounts or making sure once a year to update just to make sure your investments are in line with your goals and needs. That's like passe. You don't need to do that because I've had a really good run. I bought some good high tech companies and it worked out for me and I made a really lot of money. So, I pretty much got it figured out. I don't need that sort of those old, tried and true and tested methods. What I can tell you is there could potentially be a cost to investor overconfidence. Right? A few years in a row of double-digit gains. It's much easier to make money, obviously, when everything keeps going up. But that's what people forget. Right? It's really easy to make money when things go up. When things go down, not so fun. And for some reason, they don't come out of the woodwork and say, "Hey, you know what? I lost money. I bought, high flying stock and it dropped by 75%. You don't hear so much of that, right? The temptation for investors is to start taking more risk than they're able to handle when things keep going up. Of the last couple of months, I've received many phone calls from clients who all of a sudden want to sell sort of their boring assets in their portfolio and start moving into more speculative individual stocks. Whether or not this makes sense is based on each individual's specific situation, risk profile, what have you. But the danger in the approach is that investors are becoming too confident in their investing abilities. And as we like to say, doesn't always end so well. Years ago, I came across an article from Tony Giordano, who was a senior portfolio advisor at Vanguard. And he quoted a piece from the Journal of Economic Perspectives titled "Overconfident Investors, Predictable Returns, and Excessive Trading." The report said, and I quote, "Investors attribute strong portfolio performance and high returns to their skills, which leads to self-assurance. When the same investors experience poor performance and low returns, they attribute it to bad luck. The result, persistent overconfidence. It's that persistent overconfidence which can lead to poor investment decisions. Call it greed or whatever, but I've seen too many times where after a good year in the market and loses sight of his financial goals and needs and decides to chase after higher and higher returns. And as you all know, what eventually happens, it's not pretty." I agree. I've seen it also, right? In a seminal study by Brad Barber and Terrence Odian, it was found that individual investors who traded most actively earned annual returns. Get this. They were about 3 percentage points lower than the market average. In other words, their confidence in their ability to outperform the market translated into worse performance than a passive buy and hold strategy. Similarly, Dalbar's annual quantitative analysis of investor behavior repeatedly shows that the average equity investor significantly underperforms market indices over time. For example, over a 20-year period through recent data, the S&P 500 returned around almost 9.9% annually. Yet the average equity investor earned only around 5.2%, a gap largely attributable to poor timing decisions driven by emotion and overconfidence. So we see that over time, just like the best investors in the world, there's a good chance you're not going to be able to outperform the market. In fact, you're going to leave a lot of money potentially on the table because you're going to severely underperform the market. These studies confirm what many financial advisors experience firsthand. Investors believe they know more than they actually do. They trade frequently, chase past performance, and ignore diversification, all because of an inflated sense of certainty. I'll take it even a step further. I'll say that people speak to their friends who then transfer their overconfidence. I recently met with somebody who told me, "Yeah, I've got some money, and my friend told me I should do X, Y, and Z, and I'll do it myself." And I started asking questions. The guy had no clue what he was talking about, no clue to the basics of even having to open how to open up a brokerage account, to certain terms, to how to make the trade. I mean, the ABCs. Forget about the substance of what the person was talking about. It just doesn't make sense to me why you do that. Because somebody told you that's what you should do. Here in Israel, everybody jumped on the bandwagon for what's called a Karen Hishtalmut. Put everything after the S&P did really really well over the years. So a lot of the local firms came out with you could link your Karen Hishtalmut to the S&P 500, and all of a sudden it became the trend. Everybody started to do it, do it, do it, do it. And everybody's out there doing it. Well, what would you know that over the last couple of years, the local Israeli market trounced the S&P 500, Israel having the best stock market in the world in 2025. And compounding that with a serious depreciation in the dollar versus the shekel, it was a disastrous thing to do. None of these people were for the most part, were not professional investors. They didn't know what they were doing. They oh, this is what we should do. My friend told me you should do it. Well, I predicted a couple of years ago it's not going to end up so well, and it didn't end up so well. I don't know what the future holds, but it, before you jump into these things, know the downside and know what it is you're doing. To pile into a well-known, high-flying stock is not strategic necessarily. And a big part of investing actually should be about strategy, long-term strategy, because ultimately, right, the money is there to serve a purpose, to serve and to try to help us accomplish our long-term goals and needs. Part of that entails how much risk can you take, and when should you take that risk? These are all bigger questions than just I saw a headline that said, the three best stocks to own for the next 3 years. And since I already own one and I did really well with it, I'm going to buy the other two. Resist the temptation, right? Going back to Tony Giordano, he sums it up when he says, if strong market performance makes you headstrong, with the possibility of quick returns, avoid the temptation to go after investments that will expose you to more risk than you'd feel comfortable with under ordinary circumstances. On the flip side, if poor market performance tempts you to flee to cash, consider the longer term implications, which include missing a potential market rebound and losing future growth opportunities. What he's ultimately saying is that, people are emotional beings, and when things go up, everything's fantastic. When things go down, they panic, and you shouldn't do that. You have to sit down long and hard and understand, know yourself. If you have that self-discipline, great. But if you don't, it probably pays to work with somebody, because it's going to, over the long term, save you a lot of money. I've said it 1,000 times, but it certainly bears repeating. Creating your asset allocation, right, which is the mix of stocks, bonds, cash in your portfolio, is the single most important task an investor has to face. Many studies have shown that the proportion of stocks, bonds, and cash held in a portfolio has a greater impact or greater effect on returns and volatility than individual investments that are chosen. That's why, after assessing one's investment goals, it's of utmost importance to create an allocation that can help you achieve those aforementioned goals, especially after market run-ups over the last few years. It's important to reassess your portfolio. Much has changed in the world over the last year or two. Investors should take the time to make sure that their portfolios are well positioned for current conditions. In time periods when stock returns are much higher, many investors can find themselves with portfolios which in turn are much more aggressive than they initially bargained for, they initially set up. Which leads us to one of the most overlooked aspects in long-term investing, and that's rebalancing. Rebalancing is important because for two reasons. One, it keeps your portfolio in tune with the way you want it to be, with your long-term goals. And second, it keeps your asset allocation in line with your risk level. So what's all this mean, right? Stay the course that you started out with. Part of your financial plan took into account those great years, those good years, right? That's part of planning. And, you know, you say thank you. You had a couple of good years. Thank you. But stay the course. Keep to your own allocation. Don't get full of yourself. Don't get overconfident and start getting more and more aggressive. And because in the end, you're going to probably end up making mistakes, which are going to be very, very, very costly, right? If you follow your asset allocation, rebalance your portfolio, you'll be able to achieve, hopefully you'll achieve those financial goals, which ultimately is the point, right? That's why you're doing all this. Okay? So tune out the noise. Don't think you're God's gift to investing. Don't think your friends are God's gifts to investing either. Stay the course. Rebalance as needed. Reassess your goals and your needs. Make sure your portfolio is aligned with those things, and over time, you'll do just fine. You've been tuning into the Aaron Katzman Show. We speak about your life and money and your investments. If you like this content, please hit the like button below if you've not yet done so. Please subscribe to both the podcast and to the YouTube channel. And if one of those people that's giving you advice, they might find this of interest, why don't you go ahead and hit click the share button and send it to them as well. Thanks so much for tuning in, and we'll speak to you soon.